Welcome to How To with Mia and Ziad. Today we are talking about inflation. All of the major headlines are screaming, inflation is rising, how to hedge against inflation, what does inflation mean for economic recovery following the pandemic? But you may be sitting here thinking, I know I had to learn about inflation in Econ 101, but what is it again? What causes it? How is this going to affect my investments? And that's what we are here to talk about today. Now, before we continue, take a second and hit that subscribe button on our YouTube. Go and follow us on our other social media accounts. It's all under the handle Gerber Kawasaki. And please do not take this as personal advice. If you have questions about your specific situation, please ask your financial advisor. And with that, let's get started.
In the past year and a half alone, we've seen trillions of dollars printed and pumped into our economy, which naturally raises some concerns around inflation. We've been getting a lot of questions from clients about inflation and how it affects the markets. So we want to take some time to dive into what inflation is, how it does affect investments, and what you can do to make sure you stay protected. Let's get into it.
So what is inflation? Inflation is the decline of purchasing power of a currency over time. So since everyone is talking about AMC at the moment, let's use them as an example. In 1960, in an AMC theater, popcorn was 5 to 10 cents. Their large popcorn today now costs around $9. If you're going to the movies with 10 cents to buy popcorn today, you're not getting any popcorn. Maybe popcorn isn't your biggest priority, but not planning for inflation can greatly affect your ability to buy a house in the future, adequately plan for retirement, or continue just the standard of living that you're used to.
On average, inflation has gone up about 3% a year for the past 50 years. That means that if your money isn't growing at a 3% minimum, you more likely than not are losing money. That's why it's so important to make sure that your money is working just as hard as you do to earn it.
So what causes inflation? It would be nice to pinpoint one cause, but of course that's not how it works. So 5 causes. First one, money being printed causes inflation. What happens when there's an increase in the supply of something? So think about this. We start out with our typical supply and demand chart. Supply increases, there's an increase in price. 2, second reason, inflation can be caused by a demand pool. If there is a large demand for an item, say this water bottle, but there are only so many water bottles, the economy starts to work like an auction. Whoever is going to pay the highest price is going to get it. And people are going to pay an inflated price because they want it. 3, third reason, cost push. Let's say that it's used to cost 50 cents to make this cup. Now it costs $1. Starbucks is going to have to increase the price that they sell this cup for. Fourth reason is a domino effect of the previous one. So prices of goods increase, wages are going to have to increase to purchase these goods. I bet you thought we were done, but 5, fifth reason, and probably the one that you've heard of the most, interest rates. What's the connection here? When interest rates are low, businesses demand more for their loans because they don't have to pay as much additional when they're paying it back. This circles back to the first point. By borrowing more, the reserve banking system, you're increasing the money supply. So low interest rates can lead to more inflation, but inflation and interest rates are inversely related and they can cause each other.
The Federal Reserve, or the Fed, has a lot of influence on controlling inflation. They have a few levers that they can pull to impact economic activity. The 2 major ones being adjusting interest rates and modifying cash reserve requirements for banks. The bank doesn't have to have as much cash on hand, the more willing they are to spend and more money that's being pumped back into the economy. While vice versa, if banks have to have higher amounts of cash reserves, the tighter their wallet becomes and the less money is being pumped back into our economy. Now, this has an effect on inflationary rates where if there's smaller cash reserves required, then there's more likelihood for inflation to rise. So if the Federal Reserve wants to limit inflation, they can simply raise the required cash reserves from banks to help provide that buffer. Interest rates act very similarly. The Federal Reserve has the ability to change short-term interest rates, which affects economic activity. The lower the interest rates, the easier it is to borrow and spend more money on investments and other activities. While the higher the interest rates, the less likely people are to borrow, the more likely they are to save instead. Now, interest rates are a critical component of our economy, which is why people are constantly paying attention to it. The lower the interest rate, the higher likelihood we'll see a rise in inflation, while higher interest rates, the less likely we'll see that happen.
Depending on the assets that you own, inflation can affect your investments in various ways. If you have an asset with a fixed long-term cash flow, inflation is not its best friend because the purchasing power of those future cash flows will fall over time. Commodities and other assets with adjustable cash flows, these are assets like real estate, so rental income often do well with rising inflation. Then based on an analysis from the U.S. Bank Asset Management Group, which we will cite below, over the past 30 years, U.S. stocks have risen in price during times of inflation, but this is very dependent on the market cap and the company overall.
There's a few ways to make sure that you aren't losing purchasing power to inflation. Now, one of the major investments that you can be making is in TIPS. TIPS stand for Treasury Inflation Protected Securities. They're bonds issued by the Treasury, but unlike most bonds that have a fixed interest rate, these bonds have a variable interest rate that's tied to an inflation correlated index. Basically, what that means is that as inflation rises, the amount of interest that you're receiving is going to rise as well with inflation. But the same goes the opposite direction. If inflation rates do go down, you'll receive a lower interest or coupon as well. Stocks are also a great investment and generally do perform well in a rising inflationary market. The reason behind this is that when you're buying a stock, you're not just buying a company, you're buying the equipment, you're buying the buildings, you're buying the intellectual property, along with the physical assets that come with that business. So as the value of the dollar decreases, the value of these goods, of these intangible items as well, don't necessarily go down as well. And so you're able to make sure that you're staying in pace, if not outpacing inflation with stocks. Commodities are a great investment to make in a rising inflationary market. Gold specifically is a very popular investment to make to combat inflation. The reason behind this is that there's a finite amount of gold on this planet, while technically we can produce an infinite amount of dollars. And so as inflation goes up or as money is being printed, the amount of gold that's around stays the same. And so the value of that gold goes up with the amount of money that's being printed. It's clear that a potential rise in inflation is leading to a lot of concern from investors, but really what it boils down to is understanding the risk that comes with your investments. And that's exactly what we're here to help with. We're here to sit down and make sure that the investments that we're making make sense for your situation and your goals. So what are you waiting for? Reach out to us. We're happy to sit down for a consultation and make sure that your investments make sense for what you're looking to accomplish.
Thanks for being here. It's always a pleasure. If you're hanging out with us here on YouTube, don't be shy. Hit that subscribe button, hit that like button, comment what you think of the episode, and let us know what you want to hear next. Call us anytime. Dial it up, 310-441-9393, and we will see you next week.
See y'all next week.